So in our last segment, which I know you found very exciting, we discussed product versus period costs. Now we're going to answer the question, why the hell should you care? So product costs include the costs that are involved in acquiring or making the product. These are direct materials, direct labor, and manufacturing overhead. And it would be a good idea to get used to these abbreviations because I'll be using them throughout the semester. So product costs attach to a unit of the product, and basically those costs end up in inventory until you sell them. And that's why it's so important to differentiate between product and period costs. So our manufacturing product costs include 3 different types of inventory. The raw materials that we haven't touched yet are considered raw materials inventory. This would be the materials that go into the final product, like the glass that we mentioned that goes into your iPhone, or the metal casing, or the little cameras that go into it. Those would all be raw materials. Work in process are phones or any type of product that is only partially complete. So as we start adding labor to those raw materials, but we haven't completed it yet, it's still considered a work in process. Then when we finalize the product, it becomes finished goods. All 3 of these are considered assets and would show up on the balance sheet of the company. They're not expenses until the items are sold. So basically the way product costs flow through the system is you have direct materials that are used in production. Those costs are transferred from raw materials to the work in process account. Then you take labor and overhead costs. Those get added to work in process. And then once the units are complete, we go from work in process to finished goods. And then finally, and only after we sell the units, we go from finished goods to the customer, which then makes it an expense, cost of goods sold. This flow is really going to be demonstrated more so in Chapter 2 and Chapter 3. We're going to go through journal entries. I know you're excited for that, reliving some of the misery you had in 502. We'll be going through the journal entries to show you how that transfer happens on the books. But logically, at this point, you should just understand the flow. So we start with materials, we put those into production, they become work in process. We add some labor and overhead to it, and then we finish it up, it goes to finished goods, and then finally, once we sell it, it becomes a cost of goods sold, which is an expense on the income statement. So the product costs, direct materials, direct labor, and overhead, first become inventory, which is an asset on our balance sheet, and then only when we sell it does it become an expense known as cost of goods sold on our income statement. The period costs, which are those selling and administrative costs we had mentioned in part 1, really become expensed right away in the period in which they're used. That's why they're called period costs, because we expense them as soon as we use them. They don't become assets first like our product costs do. So it's really important that we appropriately identify product versus period costs, because it's going to have an impact on the income statement. If it's a product cost, it doesn't become an expense until it's sold, whereas period costs get expensed right away and affect net income right away. So let's test your knowledge. Which of the following costs would be considered a period rather than a product cost in a manufacturing company? I'd recommend you pause the video now, give it a go, and see if you are right when you come back. So we're looking for which of the following is considered a period rather than a product cost. So basically, we're looking for anything that is not a direct material, a direct labor, or an overhead cost. So let's identify each one of these in their appropriate category. Manufacturing equipment depreciation would be manufacturing overhead, which means it's a product cost. Property taxes on corporate headquarters, that would be an administrative cost. because it's the corporate headquarters, not the production facility. So that would be a period cost. Direct materials would be direct materials, which is a product cost. Electrical cost to light the production facility, that would be overhead because it relates to the production facility, which makes it a product cost. And then sales commissions would be a selling cost. Doesn't relate to producing the product, which is a period cost. So the question wants which is considered period. So that means that B and E should be the correct answer. Let's see if we're right. B and E it is. So those would be considered our period costs. That means that the property tax on the corporate headquarters and the sales commissions would be expensed in the period in which they're incurred. They would not be considered assets first.